Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. In this month's Under the Lens video, as part one of a two-part series, we talked about the elements and telltales we should expect to see if an important reversal is near. In this part 2 session, we're going to discuss just some of the signals for a topping market which we consider important. As such, we will cover the points outlined here. Continuing directly from part 1, I want to start with using the global PMI as a timing tool. In part 1, I went over 10 slides that compared the global PMI to various measures and how all those measured mirrored the global PMI with various leads and rates of change. Though they all clearly warned of a major global economic downturn being near, they didn't give a clear timing measure. The way to solve that problem is to move from the global PMI measure to a country-specific measure and overlay it with a country equity index. It is important to go at it in this sequence. Without the global PMI supporting a country PMI, then it can give a false signal. We show here the S&P 500 overlaid with the US ISM index. We see a fairly close correlation, which becomes even more tightly correlated at major market turns. We are at just such an occurrence now. We should expect to see the ISM go negative in October, which would suggest that the S&P on a year-over-year basis will compare negatively at that point. This suggests weakness between now and then, with a likely top arriving before. However, the real drop in the S&P 500 occurring in late October. This in itself is not complete unless it aligns closely with stock profits and the earnings season, particularly the third quarter earnings occurring during the worrying October reporting, which we outlined with our August LONGWave video entitled Market Risk, a Worrying Window. Global earnings per share is projected to decelerate very sharply to 9% by November. This will be driven by inflation, supply bottlenecks, unwillingness of companies to increase inventories given Delta, peak U.S. consumption, China economic weakness, fiscal cliffs, geopolitical risks, etc. The list continues to grow. This point in the Purchasing Managers Index, or PMI, is important because it is the point where industrial corporations are already experiencing cash strain because of already falling profit levels, as well as having been forced to begin paring back on investments to maintain cash balances. Just as importantly, will be if we are seeing a possible top where everyone is in because of FOMO, or what they call fear of missing out, and fewer bigger fools available to unload overpriced inventory. This point is detected by what is happening with margin buying of stocks. In part 1, we highlighted margin levels as an important element of tops, but in this session, we want to use it as a timing tool. As we showed in part 1, we have clearly excess leverage being employed everywhere in the financing of governments to student loans. It has taken the financial markets with it. But here we see that margin used for stock purchases is not only at record levels, but the cash balances underpinning it are now at record-setting levels. Though this doesn't give us a timing measure, it suggests that everyone is now as close to being all in as we might expect. The timing measure occurs when margin falls for 3 consecutive months in a row. September is on track to be the second of the possible 3 months. Again, we arrive at the end of October. Why this historically works is that the weakening in margin over the 3-month aligns with weakening in stock growth and over-leveraged investors starting to get squeezed. They see higher increasing levels of margin calls in the 3rd month. This forced selling normally precipitates an increasing rate of acceleration in falling prices and even more margin calls. We expect this to be particularly problematic this time around because of the untested passive investing in market indexes. As investors hit the sell button on their ETFs, the selling pressure across a broad array of these ETF holdings could potentially be huge. We suspect there will be insufficient liquidity in the system to handle just such a sudden shock wave. This shock wave may potentially initiate something even larger because it has been built on an over-leveraged overall financial edifice. When hedge funds and market investors become concerned about a falling market, as they are right now, they start hedging their positions. They want the upside that may still occur but are unwilling to be exposed to a significant drop. Their response is to buy out-of-the-money puts. As more are bought, these puts become quite expensive, and this distortion is called skew. It is a must-watch signal, as the timing of increasing open contract levels gives you an excellent timing tool. Currently, the downside implied volatility skew has reached a new all-time historical high. The discussion on skew is a large one because of the option Greeks that underpin it. Therefore, I'll leave you to explore on your own if you are not already involved in this. One of the most manipulative markets is in fact the options market. It is where the big players make their living off the newbies who fail to understand how the option Greeks work. The algorithms underpinning each of these Greeks is some of the finest financial engineering ever developed, just waiting to prey on the new and the greedy. However, there are times when the VIX can no longer hide the games underpinning it. The patterns become quite pronounced and repetitive. We appear to have reached just such a point, with critical upper resistance trend lines marking major changes if and when violated. We are currently witnessing a regular options expiration gaming play. We see 20% of gamma evaporating regularly at monthly options expiration close, and market makers are squeezed into that drop. Then violent buying of the most shorted stocks occurs after. We track this closely at MATA-SII as part of our chart package. This behavior, which has been supporting the market, is nearing its inevitable conclusion, the September quadruple witch may possibly be its last hurrah. Again, we see problems in October and a possible October options expiration gaming being a failure. When big players and institutions begin changing strategies, it shows in monthly technical charts. We watch closely at MATASII.com the relationship between monthly, weekly, daily, and hourly chart patterns and their supporting indicators and momentum measures. This is a core methodology of trend followers who isolate trend changes and then follow existing trends until their exhaustion. Trend followers depend on their ability to recognize inflection points that herald trend changes. You often see our MATA-SII charts identified as primary, secondary, and tertiary charts. This is part of our trend following methodology. One of the many elements we examine within this methodology are reversals within monthly, weekly, and daily cycles. Monthly reversals are very critical to us. Shown here is an example of the S&P against its monthly cycle, shown at the bottom as half circles in gray. August gave us a clear proprietary signal of a coming trend change, and we now look for the monthly bars to confirm this. Our proprietary momentum indicator in the bottom frame suggests a turn in momentum, which is yet another element we use to isolate and confirm market reversals. When you align with the prior signals we have discussed, we have further concurrences of timing. Another critical element we look for regarding market tops is what is referred to as Fib clusters, Fib mates, and how they align with Bradley turn dates. Shown here are the details of one Fib cluster from the McHugh Market Forecasting and Trading Report at thetechnicalindicator.com, which indicates a significant Fibonacci cluster turn window approaching from September 15th through the 23rd, plus or minus a week or so. For those that are not familiar, the Fibonacci number series is 1, 1 plus 1 equals 2, 1 plus 2 equals 3, 2 plus 3 equals 5, etc. There are 7 former tops or bottoms that occurred, a Fibonacci number of trading days from this coming 6-day period of time. Often significant trend turns occur when we see a large number of these former tops or bottoms of Fibonacci number of trading days within a tight period of time. If a prior market top or bottom is included in the cluster within a tight window with a large number of past highs or lows, typically the more significant the coming turn. No guarantees, but the incidence of trend turns is pretty good when we see these. This particular cluster is well represented with 7 former highs and lows and a major low in the group. It is coming when patterns and wave mappings are warning of an approaching top. It comes with many large bearish divergence evident between the market stock indexes and their 10-day average advanced decline line indicators. It is also arriving during a typical bearish seasonal period of the year. When we overlay these 5 dates, Elliott wave counts, and Bradley numbers, we get yet another set of market topping signals to support, or should at least be concurrent with, our target dates. Remember, market highs and turns can often be expected to happen prior to the market actually falling dramatically and perceptually. You will notice at the bottom of this chart the divergence with volume against the recent price rise in the S&P 500. Divergences are yet another set of market topping signals we look for. Volume is important and ties closely to the margin signals we highlighted earlier. We look for divergences in a raft of areas, starting with market breadth, which we are currently witnessing, where we consider breadth against the number of members of the S&P 500 below their 200-day moving average. We look at divergence between the NYSE cumulative advanced decline line on the left and both the NYSE stock market index in the center and the S&P 500 on the right. We look at the value line geometric index against the S&P 500. All these divergences don't give us a precise date when viewed separately, but when viewed as a whole against a stock index such as the S&P 500, we get a pretty good eyeball sense, which then must support our previous signal dates. We also consider well-established divergences, such as the infamous Dow theory, that stipulates that the tranny's divergence always leads the Dow downward or upward. We see the trannies have broke the megaphone fractal pattern we outlined in part 1. We then go through a raft of international market indices to see if they are also signaling the same patterns and turn dates with no divergences in message. We will see different patterns, of course, than the S&P megaphone pattern, but we'll still see the same worrying technical warnings, whether they are ending diagonals or throwovers on a resistance channel as shown here for the Euro Stock 50. The message is the same and the timing approximately the same. Shifting sentiment is always important at tops, and we have found the combination of the consumer confidence index, consumer sentiment from the University of Michigan, and the consumer comfort index from Bloomberg are particular effective tools when we again see 3 consecutive months of deteriorating readings across all these after an abrupt reversal. We should expect to see this in total, current conditions, and expectations measures. Again, the message is the same. Some tops are much more important than others, and some come with larger price adjustments than others. This is called degree level in technical parlance. Here we like to see what is referred to as the Hindenburg omen. The stock market generated an official Hindenburg omen on Tuesday, August the 17th, with a second observation in as many days. It had up to 30 days to get a second observation, but chose to do so immediately. It is important that the stock market have an open Hindenburg omen for a stock market crash to occur, since all crashes have occurred with one of these rare signals on the clock, and there have been no crashes in the past 35 years without one. This Hindenburg omen coordinates well with the market patterns, wave mappings, major divergences, weakening breadth and volume, and overbought measures that warn of a coming major stock market decline. While an individual signal has very little value in forecasting a stock market crash, a cluster of signals can be valuable in that it signals a pattern of dispersion that is not compatible with a healthy uptrend. A total of 10 Hindenburg omens have triggered on the NASDAQ over the past 6 months, a level that has regularly warned of significant stock market turbulence ahead. The following 6 weeks, as highlighted in this chart of stock market action, prove the value of this sort of signal. So, what are the conclusions? Between Part 1 and Part 2, we currently have overwhelming evidence that something important is going to occur between now and the end of October. However, we need to stress in the strongest words possible that markets can change dramatically and suddenly on important news or behind-the-scenes activity. A coming market event has been widely telegraphed, and you can be assured that the powers to be are well informed and well aware of this and can little afford serious turmoil in the financial markets. Don't forget that during all recent market turmoil, the powers to be have changed the rules. They can be counted on to not play fair. They do cheat, and they get what they want. Expect the unexpected. Stay alert, as it may in fact save your portfolio. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future. So take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom actually been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2021 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.